includes interest income, the company's share of equity earnings, and other recurring non-operating items. EBITDA is the operating profits before interest income, interest expense, income taxes, depreciation and amortization, and asset impairments. What we want to see here is an increasing trend, and we can also see it as a percentage of revenue. Next we have net profit after tax, or NPAT, which is the company's earnings after tax and all accounting adjustments. And we calculate this as profit minus the tax expense. And again, we want to see this increasing over time. So return on equity is the amount of net income returned as a percentage of shareholder equity. ROE measures the corporation's profitability by revealing how much profit a company generates with the money shareholders have invested. And we calculate this as NPAT divided by average shareholder equity. This is an important ratio because it tells us how effectively the company is using shareholder money. If the percentage is lower than what you could do with your own money, it would be opportune to look at investing your money elsewhere. In the same respect, we can also compare the ROE of different companies using this measure, as every company will have different amounts of equity. Here we also want to see an increasing trend, and this can be done by either increasing your NPAT or decreasing the amount of equity. So as Mark mentioned before, ways that you can decrease your equity are through things like a share buyback or paying out more dividends. So earnings per share, EPS, is a really important measure that tells us the profit of the company as a measurement of what it is worth to each individual share. EPS is generally considered to be the single most important variable in determining a share price. We calculate this as NPAT minus minority interests, which are dividends of preference shares, and divide the number by the number of shares. Note that the number of shares changes, so this will always be changing. It is more accurate to use a weighted average number of shares, but for simplicity we usually just use the number of shares at the end of the period to make it easier to calculate. The EPS shows us the relationship between profitability and share price. For example, two companies could have the same EPS but very different share prices. This then tells us which company is relatively cheaper. To do this, we use the PE multiple, which we will go through next week. An important aspect of the EPS, which is often ignored, is that capital that is required to generate the earnings in the calculation. Net tangible assets, or NTA, are the physical assets of a company which can be sold. We calculate NTA by subtracting intangibles such as goodwill and trademarks from net assets. Basically, we want to know what can be crystallised. Goodwill and intangibles are calculated as the amount on top of book value that a company pays when acquiring another company. It cannot be guaranteed that someone else will pay the same amount, and therefore we subtract it when calculating tangible assets. NTA can also be expressed as a per share basis by dividing by the number of shares. Interest cover is how many times a company's earnings are more than their interest expense. We want to understand if and when a business can pay off its debts. We calculate this as EBITDA divided by net interest financing costs. And so we want this to be high. The higher the better. For example, if one company has an interest cover of 10 times and the other of 2 times, the company with 10 times interest cover is in a better financial position. If a company has interest cover of less than 1.5 times, it would be very worrying as to how the company would pay off its debts and make profits in the future. So gearing ratios help us determine the proportion of a company's assets or equity that are financed by debt. The higher the ratio, the more leverage the company and the greater its financial risk. Debt ratios vary widely across industries, with capital-intensive businesses such as utilities and pipelines having much higher debt ratios than other industries like technology. A gearing ratio which is greater than 1 means the company has more debt than assets. On the other hand, a debt ratio less than 1 means the company has more assets than debt. And so ways to improve the gearing ratio could be through improving profitability, reducing debts through profits, or increasing equity through new capital. Businesses are funded through different mixes of debt and equity, so we calculate enterprise value to determine the takeover value of a company. It is an alternative to the market capitalisation. Enterprise value is the sum of the market cap and the debt of the company and ignores the ratio of funding. We can also note that EV can change regularly since the changes in share price will affect the EV when nothing has changed in the accounts. We will explore the importance of EV next week. So if we just have a recap on basic accounting, the simple income statement shows us that a company starts with revenue, and then we take off operating costs to get EBITDA, and then we take off depreciation and amortization and we get EBIT. Because these are non-cash accounting items. And then we take off interest expense and we get profit before tax. And lastly, if we take off our tax expense, we get NPAT. Here we've described ROE in terms of a breakdown. So this is the DuPont equation. So it breaks down the ROE into different components. We can split the standard ROE equation from NPAT over equity down to profit margin by turnover by financial gearing. As a manager, if you can change any of these three levers, you can improve your ROE. This is also good to show us where a company has gone wrong with one of these components. And so we can expand the DuPont equation even further by splitting up profit margin into the tax burden multiplied by the interest burden by the EBIT margin. Does that make sense to everyone? How we got those ratios? Yeah. Yeah, so basically, if you cancelled things out, you would still get NPAT over equity. And so, finally, once all our analysis is done, we've done all our maths and calculations, we need to look at the subjective aspects of a company. There are no right answers to this bit, but everyone can end up with different opinions. For example, we could look at management capability and stability. Does the management have experience? Are the people who run the company now the people who started the company? Are there any rumours of squabbling behind the scenes? Is there a new MD? Does he have experience, and what is his background? What's the company's corporate strategy? Have they now decided to expand overseas? Is this a good idea? Are there political or legal risks to the new country? What is the market structure, such as how many competitors do they have? Are there barriers to new entrants? Does the company have a competitive advantage with their product? What's the growth potential of this company? Is it either organic, which is which means to use their own resources, or inorganic, such as making an acquisition. Is the margin outlook stable? Is there a trend? The quality of their reported earnings. Are their profits one-off items, or are they continuous and sustainable? And there are a few other things you can look at there to consider. So next we have a case study on Kiwi Appliances that Mark will go through. Yeah, you don't think anyone will have questions?
So Kiwi Appliances is a hypothetical company that we've made up. It's based in New Zealand, but also operates in Australia. And I'll just flick through some of the salient aspects. I assume you've got a chance to read through this. It's a wholesaler and provides some of the main, supplies some of the main independent retailers in New Zealand. Note here there's 140 million shares on issue. It's listed on the ASX. This is important. The share price is $2.20. Over here we see that they've been undertaking acquisitions. They've closed some facilities about a year ago. Over a year ago, nearly 2 years ago. There's Mr. McLeod is the CEO, Managing Director. He's retiring, but he owns 19% of the shares. They've just refinanced a lot of debt, and they're going to save 100 basis points, which means they save 1% on the interest rate that applied, I should say during FY14, Kimberly. On it. Yeah, that should say during FY14. So in calendar 15, they're going to save 1% on what they paid last year. It's a bit out of date. So it should say 14, sorry. And 65% of the shares are owned in New Zealand, 35% in Australia. The company has a 50% payout ratio. And these are the financials, the income statement and the balance sheet. Now what I want you to do is, during the lecture now, over the next 10 minutes, calculate these 9 fundamental statistics. Kimberly's given you the formulae for each of these. So go and have 5 to 10 minutes, see how many of these you can calculate. Happy if you work in pairs if necessary. And then I'll ask random people for their answers. Okay, we might start with some of the answers there. So I've got any volunteers for the return on equity question, the first one. So, any volunteers? 28%? How did you get that? What did you put in the denominator? Yeah. That's a reasonable solution, but I use the starting equity because just you only had that starting equity to begin with, and that was your return on your starting equity. So I had a starting equity. So you used a what was your numerator? Yeah. So you had 32.6 on 116 or so, and you got about 23%. 27, yeah, okay. Yeah, in the answers that I've published, I took the numerator at the same, 32.6, and I just divided by starting equity. But your answer is quite appropriate also. So you had 32.6 divided by the average of 100 and 133. So that gave 27%, whereas I had 33%. How did you go on the earning? What's your name, sorry? Chad? Yeah. How did you go on question 2, the earnings per share? Still doing it? Anyone done question 2, earnings per share? Sorry? 23 cents. And what was your equation?
Net profit after tax over number of shares outstanding.
Yeah.
That would be 32.6 over
20. Yeah. So you had 32.6 divided by 140 million shares. And your answer was 23.3 cents. That's correct, spot on. So the company earned 23.3 cents per share in calendar 14. And what was your dividend?
because I used my equity 133 instead of 100, so I got the answer.
Sorry? Did you get a dividend per share?
No, because for dividend per share I used 133 instead of 100, so I got the answer wrong.
Right, okay. Anyone else got the dividend? It's pretty easy. It's a 50% payout ratio on your earnings. So it's 50% times the 23.3. So it equals 11.6 cents. Anyone got the net debt? 500? How'd you get that?
Total liabilities minus cash.
Yeah. So what was your total? Total liabilities. No, it's just the debt liabilities, not total liabilities. So you took 600 less cash of 100, but it's only the non-current bank debt. So should be 400 million less 100 million. So it equals 300 million. You don't use all liabilities. Easy, that's a simple mistake to make. So what would be the gearing ratio if we have 300 million net debt? What's the formula there? Anyone else got that formula? So the formula would be net debt divided by, you can either use equity or total assets. I'll use total assets. So we'd have 300 divided by 733. So the gearing would be I think that's 43%. 41%. Enterprise value. Now, this is a bit of a tricky one. Has anyone thought about that? Anyone got an answer for enterprise value? That's the market capitalisation. 908. A little bit high. Because we've got, what was your equation?
Market cap plus
Yeah. And what did you get for market cap?
2.2 multiplied by 140.
$2.20 times 140 million shares. That's right. That equals 308. And your net debt is 300. So it should be 608. I don't know how you got your 900.
Because I use total
Oh,
liability.
yeah. EBITDA. So there's two ways of doing EBITDA. We can take the pre-tax profit and add back depreciation and amortisation and the borrowing cost. Or we can take revenue less expenses, less the impairment losses. So if we take 46.5, we add back 10 million depreciation plus 10 million amortisation, and then we add back 36 million of borrowing costs. So we'd have 46.5 plus 10 is 56.5, plus 10 is 66.5, plus 36 would be 102.5. Oh, sorry. Interest cover is the ratio of EBITDA divided by the interest expense. So it's how many times the interest expense is covered by EBITDA. So we'd have 102.5 divided by the interest expense, which was 36. So the ratio works out at 2.85. Then the NTA per share is we have to go to the balance sheet. So if you look at the balance sheet, the total assets are 730, the net equity is 133, but we have to deduct brand names and intangibles. So we have to deduct 100 million. And then we divide that by 140 million shares on issue. So it equals 33 on 140. So it equals 23 cents, I think. So the only other one we haven't covered there is the price earnings multiple. So the PE ratio was $2.20 and the historic earnings were 23.3 cents. So the PE ratio would be, I think it works out at 9.5 times. So you basically, in like 10 minutes there, we've covered all the basic statistics that you would need to do to analyse a company. And these are the numbers that you could look at for GE, which is in the assignment. By the way, there's a typo in the model solutions. The columns are misnamed 14 and 15 when Veronica puts them up. We'll fix it up. We'll fix it up by tomorrow morning. So maybe we'll hold fire before you put them up. Okay? Now, you guys did really, really well with that. I think you guys, that's the best I've ever had at answering that question in the class. Fantastic. Give yourselves a pat. Fantastic. What was your name? You did really well. Terry? Brilliant. You're going to be a stock analyst. So, now we come to the sort of more interesting question, which is what I want you to do is actually model the earnings for the company going forward in 2015. So they're the answers. Well, actually, the heading's a little bit wrong. So anyway, the answers will be there tomorrow. If you didn't follow everything I got, we'll have the answers up on the website tomorrow. Now, here we have the income statement for Kiwi Appliances. And just in the class now, this is what I want you to do is do what an analyst would have to do, would be to forecast the earnings going forward for 1 year and make an earnings forecast for next year. So what I want you to do is take all these line items and using the information I've given you in the question or any other assumptions that you think relevant based on the trend, make a forecast for each of the items for calendar financial year 15. So you forecast the revenue, the operating costs, the borrowing costs, the impairment charge, depreciation, amortisation, and the tax. So just take 5 minutes, work in pairs if need be, and this will be a very useful exercise to forecast a company out 1 year. So just take 5 minutes.